Private equity giant Blackstone out with first quarter results a short time ago. We want to get more on this quarterly performance, tariffs, markets, and so much more. I want to bring in Jon Gray, President and Chief Operating Officer of the Blackstone Group. There's about 1,000,001 things that we want to talk to you about, John, and boy, are you right in the center of it all. Why don't we talk first, though, about this earnings report? It was good on a relative basis to where the world is, but of course the world is a complicated place right now. How do you look at it?
Well, I'll start with the quarter, Andrew. Great to be with you as always. We had a terrific quarter. We had inflows of $62 billion, which was the most in nearly 3 years. We delivered in all our major strategies in terms of positive performance, despite the turbulence out there. That is our true north, delivering for our clients. And what's really exciting is we have a number of big areas: infrastructure, private wealth, private credit. All of those areas have a ton of momentum. So we realize we're heading into a more difficult period, but we're on a very firm foundation.
You put a lot of money to work, even in the last quarter. So what is your thinking about where we really are?
Well, in terms of where we are today, we're obviously facing a more difficult environment. Everything changed on April 2nd. I think what we need is a little bit of perspective here. There's certainly a lot of pressure in parts of the economy where you're focused on input costs, manufacturers, retailers. There's now also, of course, market dislocation, which you guys see: M&A activity, IPO activity, spreads going wider. And then there's the risk of this moving into the broader economy and there being more of a slowdown here. And all of these obviously create real challenges. But what I would say is, if you want to have a little bit of optimism in the face of all this, is it's not like crises in the past where we had the global financial crisis and we had trillions of dollars of excess debt that was out there. It's not COVID where we were all forced to go home and be in our pajamas and shut down big portions of the economy. This is policy-induced stress. And It can change very quickly. So I think this tariff diplomacy can move. And I think as investors, you've got to recognize that certainly the faster it's resolved, the better. So
do you say to yourself, I need to invest into this uncertainty? I look at the last quarter, your deployment of capital year over year was up 48%. The other question would be, should have you waited for this moment, given that the world has turned? This was $36 billion that you put to work.
Well, we obviously, our firm continues to grow, but we look at things on a long-term basis. And so we had the opportunity to buy some terrific businesses in the quarter. We committed to buy one of the biggest marina businesses in the United States called Safe Harbor for nearly $6 billion. Our private credit business continues to serve both non-investment grade and investment grade borrowers. There's dislocation in real estate. We like the moment of investing in that area as well. And yes, today, as prices reset, we've got $177 billion of dry powder. And we love having that capital. And we've started to put some of that to work on the screen as spreads have gapped out and there's some discounted debt. We're looking at public equities. And I think the reason for our optimism, it's not that we don't recognize we're heading into a more difficult period, but it's because we're long-term investors. And if you think about what really drives value, it's what's happening long-term in some of these huge trends we focused on. So if you think about technology, there is amazing innovation happening. Andy Jassy said last week that it's the reinvention of everything. Right. If you think about it in terms of relative to, say, the horse and buggy going to a car, I think that's what you're going to see from AI, from the data centers, from the power supporting it. So, yes, it's a difficult period. You have to recognize that, particularly in the challenged sectors. But if you're thinking about being a longer-term investor, when prices come down, that creates the opportunity to invest.
You're a real estate guy early on in your career. Now you oversee all of it. We've talked a lot about BREIT, your REIT product. The University of California CIO says the real estate recovery, quote, ain't happening. Are you in agreement with him?
I would say that the real estate recovery is moving forward. What I would say about that is when we talked about it a year ago, we said things were bottoming. We said it wouldn't be a V-shaped recovery, but it was all sort of falling into place, and we see that. What happens in a real estate recovery is prices fall. That's occurred. And then you see a real reduction in new supply. That's happened. Interestingly, the tariffs will make building even harder, so there'll be less new supply. And so just like the early 90s, we're in that period of time where the recovery's beginning after the financial crisis. The same sort of thing is happening. That's why you see us deploying capital. Buying hard assets at a discount at this point in the cycle makes a ton of sense to us.
Are there businesses that you own that are going to be materially impacted by the tariffs? Is there anything you plan to do about it, and what kind of impact it will have? And are there any assets that in this new environment you would say to yourself, either one of two things: we actually are going to reshore back into manufacturing from a portfolio company back in the U.S., or we're going to try to divest certain companies because, you know what, this new world is too complicated for it?
Well, we've got a relatively limited number of businesses directly in those supply chain areas, but we have some. And in those businesses, they've got to think about what they're going to do around their input costs, how they can potentially go to other locations for sourcing, how they can think about pricing, but it clearly has an impact. And that's where the greatest stress is in the economy. And so, yes, you want to focus as an investor on the things that are directly in the line of fire, and you want to make sure those companies are reacting. We were spending a bunch of time anticipating tariffs, so some of the companies have prepared, but nevertheless, this is a challenge for those businesses. In terms of going forward, I think you do have to be mindful of what does this mean for certain businesses. But a lot of what we own is less in this directly impacted area. So if you own software businesses or healthcare businesses, business services, infrastructure assets, there's probably less of an impact. And so, yes, it matters where you invest, but I ultimately believe there will be some settlement here. This tariff diplomacy is going to land. I was encouraged by what the Treasury Secretary said earlier this week, that they're making good progress with trading partners. I do believe there's going to be a resolution here, and I think you have to recognize that, even if there's going to be some pain over the next 6 months.
When you say a resolution, what do you think that resolution looks like? Does that end with a 10% tariff across the board? Do you think there are some countries that are going to be exempted fully? Does it just not mean that we're going to have, 100+% tariffs on China? I mean, what does that entail ultimately in your mind?
I would say I think what it ultimately means is some level of tariffs probably across the board. I don't know if it's as high as 10%. Maybe some companies will be exempted, but somewhere between 0 to 10% with most countries around the world. I'm assuming they're going to reduce their own tariffs, reduce non-tariff barriers. They may make contributions to greater military spending as well. I do think the China situation is more challenging. The scale of the issues there are broader that the administration's trying to address. It does feel like the tariffs there are likely to be higher, but well below, I would expect, where they are set today. And I think getting to a place where we have more certainty would be super helpful for the real economy, for markets, the cost of capital in the U.S. I do think those long-term trends are really powerful, and I'd love to get back to those. But I think it's going to be some sort of settlement at higher level of tariffs than we had before, but hopefully well below what was announced on April 2nd.
Given your exposure to interest rates, your private credit business, and everything else, I'd love for you to react this morning to President Trump's comments that he would, I think in a perfect world, he would like to oust Fed Chairman Powell, but he's very upset, at least, about where Powell is setting these rates. He would like the rates to be lower. Do you believe the rates should be lower? And how would you feel if either he was ousted or a shadow Fed chair was put in place ahead of his exit next May anyway?
Well, the Fed's in a tough spot. On the one hand, they know that goods inflation, given the tariffs, are going to go up a lot, and that's about a 20% weighting in CPI. They're also worried about inflation expectations moving much higher. So I understand that. On the other hand, they've been getting some really good data. To their credit, by moving aggressively, inflation has come down a lot. I hear all the time about sticky inflation. The print last week was just 2.4%, and that included shelter costs at 4%. And the reality is rental housing costs are significantly lower than that. Energy costs have come down. And when you look across our very large portfolio, what we're seeing in the labor market is wage pressures are coming down. I think the events of the last couple of weeks will accelerate that. So they're going to have a tale of two cities. On the one hand, goods inflation going up, I think in a one-time way. On the other hand, a lot of very encouraging data about price pressures cooling. By the way, it's similar around the globe if you look in the UK or Canada, Australia. So I think the trend in inflation is down. I do think they'll have some room to cut. And I think they'll obviously wait to see what happens with the labor market. But I've got a lot of sympathy for the position they're in today.
But it also sounds like you have some sympathy for the president in his position that maybe they should be cutting, which is something that
I
Jay
think
Powell
there's a reasonable debate, because I do think if you really were talking about transitory, the one-time step up from tariffs does feel transitory to me. And the overall trend line, if you look at almost all these areas, is downward. And I think with the softening, you'll see even less inflation going forward away from goods, where you will see that one-time shock.
John, we're going to run out of time, but I have two other questions for you. 2 weeks ago, when we saw the Trump administration turn around on the tariffs, or at least put this kind of pause in place or something, we also saw the bond market make some very herky-jerky moves. What were you thinking during that period? And take us inside that for a second so that we understand just how close to any kind of precipice we were or weren't, frankly.
Well, I think we were at a point that there was a lot of dislocation, a lot of concern for companies specifically. Many of them had been moving their supply chains out of China over the last 5-6 years, and they'd gone to places like Malaysia and Thailand, Vietnam, and now all of a sudden they were facing very high tariffs, and that created some real issues. Global investors obviously had some concern about what it was going to mean for the U.S. economy, for the dollar, for the 10-year. And we had this sort of reverberation that came out of this policy move. I think the administration made a smart decision to put things on hold for 90 days, create an environment for there to be real negotiations, and to de-escalate. And my strong view is, if they can get some of these deals done, they can take some of the pressure down. Because right now, I think the risk is we've got parts of the real economy under pressure. We also have sort of this blanket of caution that's spread out over the U.S. economy, and it's slowing things down. And I'd love to see a re-acceleration here.
John, a very astute viewer just sent me an email, who's, by the way, a big fan of what you've been saying, who actually has a little bit of a curveball of a question, but it's actually a very good question. So I'm curious where you land. We've been talking, oddly enough, about big law for the past week and what the administration has been doing as it relates to big law. Your firm uses Simpson Thacher in large part to do a lot of its work. It recently made a deal with the Trump administration. And I'm curious, as a business leader, how you think about using law firms that have either made the deals, not made the deals, and what you would do if you needed a law firm that needed to go up against, effectively, the administration.
Well, we're always
told you it was a curveball, but it's an interesting question.
Yeah, it's an interesting question. I would say for us, we always want to use the best law firms. Simpson Thacher's been our partner for 4 decades. They've been an amazing firm. They have obviously got to deal with the pressures they face. We understand that. We're going to use the best law firm available for whatever it is, be it a transaction or something corporately here at Blackstone. And for those firms, they've got to make the right decisions, and they've got to do things that make sense for them and their partners. And so we're pretty practical about where we are, about making the right decisions, picking the right partners.
And then finally, I just wanted to ask you about exiting investments, what you think this environment looks like. I mean, obviously, there was a real view that there would be lots of IPOs, lots of mergers, all sorts of things that are happening. That seemed, I mean, you talk to some of the bankers, they say that pipeline has basically just stopped. What does it look like in your mind now, given the uncertainty?
Well, right now, when you have a period of dislocation, one of the first things that falls are things like IPOs. In boardrooms, companies can hesitate. It's definitely slowed. But I would say a couple things. One is it hasn't completely stopped. Interestingly, because the direct lending market, private credit, has continued to function at relatively reasonable spreads, we still see deals getting done. In real estate, because the cost of borrowing overall has come down, the fundamentals in housing are good. We still see transaction activity there. So we haven't seen a real sort of stoppage. The other thing I'd point to is this can move. If you went back 5 years ago and we were having this call, in fact, you and I did this, Andrew, from our respective homes, we thought there'd be no deals in 2020, and we ended up with a bunch. The world can change. So if we can get some resolution relatively quickly here, I think the back half of the year can be better. If things continue to be as they are, then it will be a very slow year, I would expect, for IPOs and M&A.
Jon Gray, it is great to have you on the broadcast. We've got the ECB numbers coming up in just a moment, so we'll be watching all of that. I want to thank you very, very much.
Thank you, Andrew.
Thank you.
And the European Central Bank cutting rates by 0.25% as expected, takes the ECB's key rate down to 2.25%.